Hello, I'm Andy Agathangelo. I'm very proud to be the founder of campaign group Transparency Task Force. We are a UK-based but very international certified social enterprise. We exist to create a difference, not a profit. And our formal mission statement is all about the idea of reforming the financial sector so it serves society better. That's what we're all about. And it's for that reason that the book we're going to be discussing tonight with the author, Bob Paisley, entitled Anatomy of a Banking Scandal, is so relevant to our work. I'm going to refer to some written notes about the book, so bear with me while I quote from the web page for tonight's event. The words say, in the early 1990s, the First National Bank of Keystone in West Virginia began buying and selling securitized subprime mortgages from all over the country and quickly grew from a tiny bank with just $100 million in assets to over $1.1 billion. For 3 years, it was listed as the most profitable large community bank in the country, but it was all a fraud. All of the securitization deals the bank entered into lost money. To hide the fact that the bank insiders started cooking the books and concealing that they were also embezzling millions of dollars from the bank. This was all hidden from the bank's attorneys and auditors, federal bank examiners, and even the board of directors of the bank. To keep the examiners at bay, the bank insiders did everything possible to avoid giving them access to documents they were entitled to see, documents they knew would sink their scheme. The head of the bank, listen to this, the head of the bank even went so far as to bury four large truckloads of documents in a ditch on her ranch. Robert S. Paisley explores the failure of the First National Bank of Keystone, the intrigue involved, and the lessons that could have been learnt and still can be learnt about how banks operate, how federal banking regulators supervise financial institutions, how agencies interact with one another, and how such failures can be avoided in the future. And it's, I guess, that last point is perhaps the most important point to make here. We can learn a lot about what's happened in the past, including, of course, how to avoid similar tragedies happening again. And of course, this scandal, this massive banking scandal, is not in any way victimless. Many people suffered it as a direct consequence of what happened. So we are extremely grateful to Robert S. Paisley, we'll call Bob, for being with us tonight to talk about his book. Us in the UK will, I am absolutely sure, be able to directly identify with many of the themes that Bob's going to be talking about. The sorts of things that have happened stateside have also happened here as well. So, can we first of all, folks, please show our appreciation to Bob for A, writing the book, and B, for being here tonight to talk about it. And then after Bob has finished, we will very quickly facilitate a light conversation after that. So let's show our appreciation to Bob Paisley. Bob, thank you very, very much indeed. I'm ready to share your slides, Bob. So when you want me to do that, just say, and I'll get them up on the screen. Okay. Thank you very much, Bob. Thank you.
Yes, Andy, you can go ahead.
Okay. So let's try sharing them.
Thank you very much for having me. It's a real honor to be here and to be able to speak to you all. Let me just talk first about the town of Keystone, West Virginia. West Virginia is already a poor state within the United States, but Keystone in particular was a former coal town. One of its areas was called Cinder Bottom because of the cinders from the coal mines gathering there. It was actually a red light district, and so you can get an idea as to what Keystone was like. Its population was declining during the 1900s from 3,000 to less than 500 just after the bank failed. And Keystone was in the seventh poorest county in the country out of over 3,000 counties in the United States. Next. In spite of that lack of population and poverty, Keystone was the most profitable large community bank for 3 years in the 1990s. And this was remarkable, but Wall Street and the banking regulators didn't seem to pay it much attention, seemed to think that that was just perfectly normal. Next. And this is the bank itself that was the most profitable large community bank in the entire country in the 1990s for 3 years. I mean, it's just remarkable that a bank, a one-story, one-room bank like this could accomplish that. But of course, it was all a fraud. So next. In 1977, three people came down from Pennsylvania to run the bank. Knox McConnell was the president. Billy Cherry was his right-hand person. She became ultimately the leader of the bank. And then Terry Church came along with them. She was a close associate with Knox McConnell. Actually, she was his paramour. She thought that he would marry her, but that never happened. Knox McConnell himself died 2 years before the bank failed in 1999. He died in 1997. So next. The size of the bank when they first arrived from Pennsylvania was a mere $17 million, which was quite small, and it grew gradually over the next 13 years to $100 million in total assets, resulting from normal earnings, really nothing untoward. Next. But then Knox McConnell got it in his head to purchase subprime mortgages throughout the country. And so he asked his right-hand person, Terry Church, to go to the West Coast to talk to people there and to start buying subprime mortgages. She ultimately, over the next 6 years, bought $2.6 billion in subprime mortgages. And that led to the securitization of the subprime mortgages because the bank couldn't carry that many loans on its books due to its lack of capital. So it had 19 different securitizations. All of them were a loss, but they dummied up the books and pretended that they were making money. As a result, on paper, the bank grew from $17 million 22 years before to $1.1 billion. Next. And as you all may know, the process of securitizing loans is a very complicated one. It needs a whole host of professionals, experts, attorneys, accountants, insurers, and so on. So Terry Church knew she needed some assistance. Next. Terry Church, she ran the securitization process between 1993 and 1999 when the bank failed. She had, of course, extensive expertise on her own behalf. She had a 2-year college degree in stenography, a BA in appraisals, an MA and PhD in business administration. But what's interesting is that all of these degrees were issued on the same day, and they were correspondence degrees. So basically, she really had no expertise whatsoever, either in banking and especially not in the securitization of mortgages. So Church decided she needed some help. So next. So she reached out to 3 people who were in the bank for their expertise and assistance. Wendy Sue Pack went to a religious college on the West Coast. Her major was music. She had absolutely no banking background whatsoever. Debbie Watkins, the second person that Terry Church chose, was the drive-up window teller, and she had no expertise in securitization of subprime mortgages. Mommy D really took the cake, though. She was a relative of Terry Church's and acted as a janitor for the bank. So she definitely had absolutely no experience in the very complicated areas, the securitization of subprime mortgages. Next. One of the people assisting the process from afar, who was helping to sell loans to the bank, indicated at one point that it was a train wreck coming. And the bank examiners who went into the bank every year knew that something was wrong, but couldn't pinpoint what was wrong, didn't know what it was, couldn't find out what it was because they were being fed lies and false fraudulent documents that were forged. But they knew that something was wrong. They used to joke among themselves that the only accurate number in the bank was the phone number. So there you have it. And next. The bank did reach out and did obtain the assistance of various Wall Street underwriters. The first one, though, quit after 4 deals. Lehman Brothers and Bear Stearns were the next in line. And yet they, of course, were the poster children of the 2007-2008 financial crisis. So they ended up not being able to assist very much. And of course, as Andy indicated, all 19 deals were failures. It was reminiscent of the old joke where one man says to the second, all of your transactions are losses. What gives? And the second man says, well, you're right. They're all losses, but I make it up on volume. Next. The bank was using an accounting rule called gain on sale, which meant that the bank or any company could indicate what its expected reasonable profits would be over the course of the year. It was a non-cash basis of accounting. It was accrual accounting. But instead of being reasonable and professional with regard to this rule of accounting, the bank simply made up the numbers. They wanted the 19 securitizations to be profitable, so they wrote down on paper they were profitable, just made up the facts. And so they had false earnings from loans that the bank did not keep and false loan servicer reports. Basically, as I indicated, that there were 2.6 billion in loans over 6 years that the bank purchased and sold into securitizations. In order to keep track of those loans, they needed loan servicers. And they were getting loan servicer reports, but when they got them, they would falsify them. They would rewrite them. And the bank examiners didn't know that these reports could be rewritten, didn't know that it was all fabrication. So they were being stymied left and right. Next. Knox McConnell was a real character. He was a small town banker, but he had visions of grandeur. And he used to make the examiner's life extremely difficult. He carried guns around and pretended he was protecting them, whereas in reality he was intimidating them. He yelled and screamed at the examiners. He complained to the main headquarters in Washington, D.C. about the examiners. He got examiners removed from the examination team. He wrote letters to senators, congressmen, and even President Bush, who was the president at this time. And he wrote letters to the controller constantly, threatened lawsuits. And one thing that I'll get into later, at least I'll touch on it, he threatened to switch charters. As you may know, there are 3 different banking agencies within the United States: the Fed, the FDIC, and the OCC. And within certain parameters, a bank can switch charters so that if it doesn't like it being regulated by the OCC anymore, it can become regulated by the Fed or the FDIC. And this was a real threat, a threat that's still current to this day. It's an incredible system. It should be changed. Next slide. The employees themselves were cowed. They were given a lot of bonuses, so they were beholden to the bank and to Terry Church in particular. They were under threats all the time from Terry Church in particular. And they indicated that no one dared talk back to Terry Church. Most of the people in the bank, employed by the bank, were women, because Knox McConnell didn't want intra-bank romances, although he himself was romancing and having an affair with Billy Cherry. But as I said, no one dared talk back to Church. Oh, and the women who were in the bank, most of their husbands were former coal miners who were on disability or strictly out of a job anyway. So they were the only income earners. And so they really couldn't afford to lose their job at the bank. Next. This is a mugshot of Terry Church. And as you may imagine, she was a very difficult person and very scary. People didn't want to talk back to her, and nobody really did. Next. In the testimony in the criminal trials that ensued, there came after the failure of the bank, one woman at the bank said she could scare Terry was very, I don't know how to put it, she was scary. If you didn't do what she said, you knew you were out the door. And the question from the lawyer was, did you ever agree with him to do anything illegal? And the answer was very simple. I'd done what I was told. Next. And similarly, another witness said, well, the lawyer was asking the question, as you testified, you said you would have been fired on the spot. And he foolishly asked the next question he didn't know the answer to, which is a no-no for all lawyers. And he asked, did you ever see anybody fired on the spot? And she answered, no. Question by Terry Church. No, because nobody ever did anything against her. Next. And of course, this wasn't true. There was one sole exception, Meredith Hale, who did talk back to Terry Church, who refused to falsify some documents that she was given, and she was fired on the spot. Next. Things were so bad within the bank that not only did they steal from the industry and falsify documents that were given to the examiners, they stole from each other. When Knox McConnell died, Terry Church and Billy Cherry started looting his estate. Now this is Terry Church, who was his right-hand man, and Billy Cherry, who was his lover. They started to loot his estate the day after he died. And first and foremost, they rewrote his will. Now that's very difficult to do after the person has died, but that was no impediment. They just forged his signature on a new will and put it into probate. But they also took his 4 checking accounts and rewrote them to be under the name of Billy Cherry. So she obtained $4 million right then and there. They opened up his safe deposit box and took out everything that was in it, including Knox McConnell's mother's wedding ring, and gave it to Billy Cherry. There were 2 CDs worth $4.6 million, and they took those. The bank stock worth over $10 million, and they took that. Knox McConnell's total estate was $23 million, and they looted most of that. But curiously, a judge handling the legal cases, the criminal and civil cases afterwards, said that all that money was fraudulent. So he really didn't have that money. Next. And as I said, there were untoward efforts to avoid regulation. The bank delayed producing documents to the examiners. They provided fraudulent documents to the examiners. But what's interesting and never occurred anywhere else, as far as we know, is that they videotaped the area where the examiners worked. So they were watching every move that they made. And they taped the examiners' work papers back together during the night. The examiners would tear up the work papers very carefully and throw them in the wastebasket, but foolishly left them at the bank. So overnight, Terry Church, Billy Cherry, and various other people in the bank would stay up late, scotch taping these work papers back together. So they knew exactly what the examiners were finding and what they were concluding. And they also went even farther and downloaded their hard drives during lunch. The Keystone itself is a one-street town. It had no place to eat, and so the examiners had to drive 10 miles away to the next town to get lunch. So while they were away, Terry Church and Billy Cherry and others downloaded their hard drives so that they would know exactly what the examiners were finding. Next. The examination process within the United States is generally one that provides only for a certain number of weeks for the examiners to be in a bank and to conduct the examination. But of course, Billy Cherry and Terry Church were able to avoid undue scrutiny by delaying the production of documents and by providing false fraudulent documents. So finally, the OCC agreed to allow the EIC, the examiner in charge, to handpick his own staff and to have no limit on the time for the examination. It could go on indefinitely until they found out what was really going on. The OCC headquarters finally relented and allowed this very unusual turn of events. The last examination was in 1999. The examiners were handpicked, and there was no limit in the amount of time that they were going to spend at the bank. So next, one thing they did was to review all insider transactions of the top echelon of the bank, which included Terry Church. And of course, When they started to do that, started to look at her accounts, she ended up yelling and screaming at the examiners. So in order to avoid this scrutiny, in order to avoid examiners looking at her accounts, she took 8 of her accounts and the signature cards attributable to those accounts and sent them across the street to where her brother worked at a gas station. And he signed new signature cards. The 2 women who did this for Terry Church brought signature cards back to the bank, but they threw them on the floor and stamped on them and put cigarette ashes over them, all of which to look like these signature cards were old and had been taken out years before. Now, the bankers also were able to convince a judge, a local district court judge, to issue a temporary restraining order, a TRO, to get the bank examiners out of the bank. This had never occurred before, but it was based on fraudulent OCC email. In other words, the bankers concocted email purportedly from an examiner who had already left the OCC. But the emails said very scurrilous things and very threatening things against the bank. It said specifically, maybe we can close the #1 bank in the country. In other words, they were going to close the bank not based on facts, but based on made up information. And then the emails also went on to say maybe we can get Terry Church and Billy Church, Terry Church and Billy Cherry with McConnell. In other words, in the grave, because McConnell had already died. So they concocted these fraudulent emails and took them to the judge, who was astounded and said that the examiners had to leave the bank immediately. This, as I say, has never happened before, but it was all based on fraud. When the examiners came back to the bank after a hiatus of 3 or 4 days, the bankers wrote graffiti on the side of the bank saying in so many words, examiners go home, and using profanity. And this scared the examiners. Next. The bankers also hired guards or pretend guards who were there to protect the examiners, theoretically. But of course, they were there to intimidate the examiners and to threaten them. And one of the guards told the examiners, quote, "You better watch yourselves driving home. There are some crazy drivers out there." The Keystone is a one-street town in the middle of nowhere, about an hour's drive from the nearest hotel. So examiners had to drive these long mountainous roads from Keystone to this town an hour away. And so it was very scary driving. And they were scared by what the guards said and thought that they were under threat, which they were. So they voted to leave the bank. And again, this has never happened. And the U.S. Marshals were called in to protect the bank. And again, this has never happened in the history of bank examination. Next. After the examiners came back into the bank, Terry Church decided that she would do some additional things to make the examiners afraid and not able to discover what was going on. When the examiners left for a long weekend, she called up her assistants at her ranch up on the hill and ordered them to dig a ditch that was 100 feet by 30 feet by 10 feet in order to bury bank documents. And she was interested in burying 4 truckloads worth of bank documents, which was amazing. And her assistant up on the ranch said, "Aren't we going to burn them?" And her reply was, "There's not enough time, and there are too many documents to burn." So she was going to hide from the examiners permanently for truckloads worth of documents. Next. After the bank failed, based on the tip, the FBI was able to dig up the documents with a backhoe, which again is a first in regulatory history, using ground penetrating radar and the assistance of a local person who knew how to identify dirt that had been disturbed. Next. In the last examination, based on a tip as to the fraud going on at the bank, and based on fraudulent brokered certificates of deposit and fraudulent loan servicer reports, the examiners were able to close in on the bank and declare it to be a loss. Let me back up for a second and explain the brokered certificates of deposit. In order to purchase the subprime mortgages throughout the country, the bank needed deposits, and they couldn't get those deposits from the local community. It was too impoverished. So they paid large fees, interest rates for brokered certificates of deposit, which they weren't permitted to have because they were undercapitalized. So they had certificates of deposit and falsified their dates, indicating that they were purchased in 1998 instead of 1999. The examiners found these certificates of deposit in the back of one of the file drawers, hidden away in an envelope. And the bankers saw the examiners uncover these certificates of deposit and went to Terry Church and said that they knew the examiners had found these false certificates of deposit. So she directed them not to go back to the examiners, but to hide out in a darkened room. So they spent the rest of the day in a darkened room, trying to avoid going back to where the examiners were. But every so often they would open the door to see if the examiners had left. And the one woman shut the door on the other woman's fingers and hurt them. Loan servicers, because of the millions of loans that the bank was purchasing, they needed loan servicers in two different loan servicers in the country to handle the mortgage payments. And they were sending reports as to the loans that they were servicing for the bank to the bank. And the information that the bankers were giving to the bank examiners indicated that the loan servicers were servicing over $500 million worth of loans, whereas in reality, they were only servicing $37 million. So it's quite a shortfall. The examiners have been asking for some time for permission to visit the loan servicers and to find out on site directly from the loan servicers whether or not they were servicing $552 million worth of loans or something much smaller. Finally, the OCC headquarters relented and allowed the examiners to travel across the country to visit with the loan servicers, and they were able to find that there was a shortfall of $550 million. And the bank at that time had capital of only $180 million. So those of you who are really good at math will know that $515 million is greater than $180 million. And it meant that the bank was totally insolvent and had to be closed. Next. At the time it was closed, everybody predicted the bank failure to be the 10th largest bank failure in U.S. history. It turned out to be the 42nd largest bank failure in the history, which is pretty remarkable by itself, given the fact that it was in this one little town of Keystone, West Virginia. Next. The OCC, in supervising the bank, from time to time had very limited, weak administrative actions served against the bank. But one of them required the bank to obtain the services of a nationally certified accountant. And all the accountants, Deloitte Touche, various others, refused the job. But Grant Thornton accepted it and spent a year in the bank looking at all the records, looking at all the transactions, and like Mr. Magoo, saw nothing. And the FDIC ended up suing them for $23 million due to their gross negligence in not being able to uncover anything amiss at the bank. And in fact, after the bank failed, they were still arrogant and indicated that the bank was still solvent. They really wouldn't even accept the facts that were put in front of them after the bank collapsed. Next. In addition to the accountants, the bank had first flight attorneys, a firm of Kutak Rock, which is out of Denver. and they represented the bank from 93 to 99. And there were 9 different red flags that they should have identified, but that they missed every single one of them. So the FDIC successfully sued them for $22 million. And the primary attorney from Kutak Rock, who represented Keystone, was barred from representing banks for all time. And I think to this date, he's still barred from representing financial institutions. Next. As a result of the shenanigans, as Andy indicated, and the fraud and embezzlement, there were 3 criminal trials. One was for obstruction of a bank examination, which is very, very rare. I don't know of another criminal case where there was a successful criminal trial for obstruction of a bank examination. The second criminal trial was for embezzlement from Knox McConnell's estate. And the third one, as you may guess, was for strictly cooking the books of the bank. Next. The main bankers involved went to jail. 5 went to prison. Billy Cherry, who was elderly, died in prison from a hemorrhage. Terry Church spent 15 years in prison, got out 11 years ago, and 3 were placed on probation. Knox McConnell, of course, avoided prison because he had died 2 years before. And I'm reminded of the quote from H.L. Mencken, who said, "Of all escape mechanisms, death is the most efficient." And that's how he avoided being convicted and put in prison. Next. Getting into the problems and issues that the Keystone bank examinations reflected were as follows. The OCC did not support the examiners. The examiners constantly told headquarters in Washington that something was wrong. They needed more money. They needed more resources. They needed to be able to go to the loan servicers, and they were rebuffed every time. The enforcement actions that the OCC did take against the bank were weak and inconclusive. Even worse than that, there were fights between the regulators. The FDIC and the OCC were fighting all the time as to how to examine this bank. The OCC was the primary regulator, but the FDIC is a backup supervisor because it insures the federal deposits. And the FDIC asked 3 different times for 3 different examinations to join the examinations, which was its right. And the OCC delayed approving that or outright refused for a time being the permission for the FDIC to join them in the exams. And then after the examinations, the FDIC downgraded the OCC ratings of the bank 3 different times. OCC would rate the bank as a 2. The FDIC would downgrade that rating to a 3. The next examination, the OCC rated the bank a 3. The FDIC said it was a 4. Then the next examination, the OCC said it was a 4. The FDIC said, no, it's a 5, the worst rating. Next. The bank was one of the first banks, albeit a small bank, to get involved in the securitization of subprime mortgages. But afterwards, there were some very large banks who got involved in the securitization of subprime mortgages. But the OCC, the FDIC, the Fed, and Wall Street just ignored this issue, ignored the risk that was represented by the securitization of subprime mortgages. And even though the Financial Crisis Inquiry Commission that was formed after the 2007-2008 financial crisis indicated that the securitization of subprime mortgages was a spark that lit and spread the flame of contagion and crisis. In other words, securitization of subprime mortgages is what kicked off the financial crisis of 2007-2008. If that had been studied sufficiently, if the reason for the bank failure and the risk involved generally with the securitization of subprime mortgages had been examined, maybe the 2007-2008 financial crisis could have been alleviated or reduced to a certain extent. Next. There were congressional hearings about the failure of the First National Bank of Keystone. And Jim Leach, head of the banking committee, said that seldom is a wake-up call as loud and clear as the one emanating from the tiny town of Keystone, West Virginia. But my conclusion is that Wall Street and the regulators slept through this clarion call, this wake-up call. Next, my recommendations are that the regulators should give more deference to the examiners. They are on site at the banks. They know better than anyone what's going on, and they should be given deference. Similarly, the OCC and the Fed and the FDIC should give more support to their examiners. I spent 30 years at the OCC working very closely with examiners, and they are the best. They should also, the OCC and the other agencies should not let banks intimidate the agency. Knox McConnell wrote threatening letters all the time, and the agencies were cowed. The agencies didn't want to get Knox McConnell mad or upset the politicians that he was writing to, and he was very well connected politically. But the agencies allowed that to affect their judgment, and that should not have occurred. And as I indicated earlier, the agency should allow direct verification of assets when appropriate. And last, my little pet peeve is that the agencies should be consolidated. The Fed and the FDIC's examining authority should merge in with the OCC's examining authority, and there should be one supervisory agency, the OCC or something comparable. The Fed should do what it's required to do of handling monetary policy. The FDIC should do what it's famous for, which is ensure deposits. But as far as supervising banks, there should be one bank to avoid regulatory arbitrage, to avoid fights between the agencies. But I want to thank you all very, very much. I'd like to open it up to questions.
Bob, that really has been a remarkable story. I mean, crumbs. Some of what you've explained is virtually unbelievable. I'm just going to have to ask one simple, straightforward question before we then go to others, starting off with John Ashton at the University of York. What they were doing was so outrageously bad. Do you think they thought they were going to get away with it? I mean, it seems virtually unbelievable that they thought they were going to get away with it, Bob. But any thoughts on the psychology of what was going on by these fraudsters?
Well, Knox McConnell, who died 2 years before the bank failed,
Yeah,
was an extremely arrogant, self-possessed individual. And I
right.
don't think he ever thought he would be caught. And he had a
Wow.
lot of very powerful friends, politicians and such. So I'm sure he felt he was immune. Terry Church at the very end realized that the gig was up and, was in almost tears. But that was not until the very, very end.
Wow. Wow. Thank you so much. Really, really fascinating story. Folks, we'll provide a link to where you can get the book. We'll put it in the chat in just a moment. Can we please go to John Ashton, Professor of Financial Regulation at the University of York? John, if you could, a minute or two on any initial comments. And after John, we'll go to Paul Bates, Nicholas Morris, Con Keating, and John Christmas. John Ashton, over to you for your initial thoughts, please. Any reflections?
Oh, wasn't that dreadful in terms of the story? Well, it was a wonderful talk, Bob. Thank you ever so much.
Well,
And
thank you.
all plaudits to you. It's such a piece of work, that isn't it? Lots and lots of digging and research to find that out, and doing it from many different perspectives as well. Finding all that information. Say what strikes me is that you do occasionally hear of shocking cases like that, but it's so extreme, isn't it? I think in the UK, a number of us, if we remember what happened with the cooperative bank,
Yes.
and a senior manager there were a bit alarmed, you know, methamphetamine and being chairman of a bank don't mix. But anyhow, digressing, it, a key issue which does strike me in this is the people, isn't it? It's the people who are deeply inappropriate for the role. And just to ask you a regulatory question, really, in many, many countries across the world, there's an expectation that if you are going to be taking a senior role within a bank, you need to have a certain set of qualifications. You need to have and or a certain professional background and be aligned with like a certain be a member of a professional body, such as the Charities Bankers Institute or any other national equivalents which could be there, or be even interviewed by a regulator for a particularly large bank. Now, in the UK, we've gone through a kind of a process looking at this, where we do register people, we do start looking at them far more closely. And it's certainly the time we're in now, we're going through a process where this is being reassessed to whether it's actually needed or not. Do we really need to worry about these concerns as much? I will say I've got a skin in the game. Many years ago, I was trying to write the documentation surrounding, for example, Nigeria's expectations for bankers, which do seem to be a bit higher than most other countries, to be honest, in terms of the qualifications required. But anyhow, digressing, thoroughly digressing. For the case here, do you think it would have been solved if there was some mechanism to screen out people that didn't have a clue what banking should be and didn't have kind of the right professional background and ethics, because this is ethics, isn't it? In terms of how they should run the bank. Do you think that would be a solution to this type of case, Bob? Or is there more that we need to be looking at here? But most of
Well,
all, before we go into the question, thank you. It was ever such a good talk. Really, I was just shocked all going listening to that all the way through. But thank you.
well, thank you very much. I appreciate your comments. With regard to this bank, it was a very tiny bank in the middle of nowhere, $17 million in total assets when Knox McConnell and the two women came from Pennsylvania down there. And Knox McConnell had some banking background, so he would qualify on paper with regard to that. In terms of his morals, his ethics, I mean, he had never been convicted of a crime. He had never been charged with any wrongdoing. So he really would have passed muster, especially since he had very, very powerful friends. Um, so it would be very, very hard to supervise that. These are small banks, of course, and even the large banks, they're for profit, privately owned banks, and so they can really hire who they want. The regulators have an ability to remove officers and directors, but it's a very high bar, and it has to be generally has to be litigated in order to be successful. When towards the very end, like in 1998, the year before the bank failed, the OCC had a meeting of the bankers, and the banking examiner, who was very young looking, turned to Billy Cherry, who was an older woman who had been put in charge of the bank after Knox McConnell died. He turned to her and said that she needed to be replaced as president. And she, of course, was titular head of the bank, but was not qualified, did nothing, was out of her element. But this was arranged ahead of time that he would tell her that she had to be replaced. And she went off. She just screamed and yelled, you young whippersnapper, don't tell me what to do. And it was really a very, very difficult situation.
Thank you very much indeed. I'm going to make one quick comment before we go to Paul Bates for his thoughts. Um, your comments, John, reminded me of something I learned about in 2019. In 2019, we did an event in Boston, and there was a chap in the group who was involved with recruiting senior bankers. And his company had a policy. They would assess the banker for all their normal professional capabilities, but they would also run an exercise to measure the individual's moral quotient. So we all know what IQ is, intelligence quotient, EQ, emotional quotient. Moral quotient is basically, and this is a very layman's description, basically a measure on somebody's ethics. And his argument was that if he was going to put somebody into a senior banking role, one of the most important things for the bank to know is the propensity of this individual to do dodgy things. Therefore, measure the moral quotient. And for reasons we can speculate, this idea doesn't seem to have taken off in the banking community because I think you're absolutely right, John. I think if we've got people running banks, they ought to have a really strong sense of right and wrong, and they ought to be people who'd be extremely uncomfortable doing anything that was dodgy. It's fascinating that this concept of moral quotient has not really taken off. I'll leave it at that. Thank you, John. Thanks, Bob, for your response to John as well. Let's go to Paul Bates, a barrister we know very well, who is qualified both in the UK and in Canada. Paul, any reflections from you, sir?
I wish to salute Bob for both the quality of his presentation and the stimulation it gives you to wish for these people to be caught sooner and punished harder and otherwise ruined before they ruin others. So it's extremely well done, Bob. But it feels like a dark comedy because you can anticipate with every sentence the disaster coming around the corner. It's very sad for people. Um, Bob, my question of you is, what about the board of directors? And was there ever any effort made for recovery against them or their insurers? I understand efforts made for recovery from auditors and outside counsel, and that's an excellent strategy. But what about the board of directors? Did it have insurance? Who were on the board?
That's a very good question. Thank you very much, Paul. The directors were, local people, but some of them had law degrees and were otherwise professional people, but they were not involved in the day-to-day affairs of the bank. They were really iced out of any such transactions. They thought that the securitization process was an appropriate one. They, of course, were fed all the wrong fraudulent information that the examiners were given. So they really had no way of being able to uncover it. And at the very end, when it became apparent that the bank was insolvent, they did, in fact, step up to the plate. They tried to fire Terry Church, tried to do the right things, called Grant Thornton back to the bank. Grant Thornton had tried to leave for the long weekend, even though the bank, they were told, was insolvent. They had been there for a year and the bank was insolvent. And yet they said, oh, no, never mind. We're going to go home to our son's baseball game. And they were called back at the last minute. And the outside directors lambasted them and, tried to get them to accept liability and responsibility. But they themselves really were not responsible. They just didn't have the ability, the expertise, or the involvement to be able to uncover what was going on.
Thank you very much indeed, Bob and Paul, for your point, your question. Let's now go to, well, so far we've had a Brit in Britain, that's John. We've had a Canadian in Canada who's also licensed in the UK. We're now going to go to a Brit in Australia. Nicholas Morris, to you.
Okay. Actually, I'm in Britain now,
Oh,
and we're in Derbyshire at the cottage. And anyway, so some of you may remember the book we wrote, Capital Failure: Rebuilding Trust in Financial Services After the Financial Crisis. And I'm reminded of all the stuff in there about framing and about how people manage to convince themselves that what they're doing is okay and right and even moral. We're doing God's work, where all these other things. And I think the first thing I'd like to say is that although this is a small bank in the middle of nowhere, Bob, the stuff we looked at was about big banks, and it was all very similar. And I'm reminded of Bernie Madoff and for a long time nobody would listen. There's a book someone wrote called Nobody Would Listen,
mm,
and it was pretty clear to anybody who bothered to look at it that the same thing was going on there, that it was all just falsified and so on, but nobody wanted to know. And the people involved there were very well connected politically, socially, everything else. Ditto Epstein more recently. There does seem to be an ability for people to convince themselves that everything's okay, even when things are not what I would call moral. We would call moral. Um, But in the capital failure book, we got a whole load of philosophers and things to think about why people behave as they do. And I remember there was this uh, investigation of a group of bankers, and when they were tested for whether they were moral and good and all these other things in the context of their families and the local society and so on, they tested very well. So their moral quotient would have been good. But when they were tested in the context of their jobs, they came over as incredibly dishonest and so on. And uh, the problem is that we human beings can convince ourselves of all sorts of things, that it's okay, that this is our God-given right to do things and so on. And the so I suppose the main thing I'd like people to take away both from this and from the book we wrote is that this is much wider and bigger than this small bank in a distant town. But Bob, thank you very, very much for all the research and all the trouble and so on going into this particular case. It's fascinating. We'll be reading it with great interest. I remember similar things, Bank of Scotland.
Yes.
I was brought back to Bank of Scotland recently because somebody wanted me to look at sort of why things failed and what it was about the leadership there that caused the problems. And it's really arrogance and hubris and getting away with it. You do it because you can. Um, and I fear other people know more about Britain than I do, but I fear that we're not really holding people to account and we're not really preventing people from behaving badly. And all the work Andy's been doing, looking at the FCA and so on, indicates that we're a very long way from having good regulators, good accountants that will actually bother to check accounts and make sure before signing off, etc. So I'm afraid 2026 is not so different from the 1990s, Bob.
Well,
Um, okay.
Nicholas, thank you very much for being with us today, and nice to see you as well. So, thank you very much for joining in. We're going to go to Con Keating next for a quick comment from Con, and then we're going to go to Michael Loughnane, who is a big fan of yours, Bob. Con Keating, what would you like to share? Thank you.
Bob, let me thank you for the book, which I have already bought but not yet read. Um, it's a classic situation. Bought the book, got delivery of it, and since when I've just been inundated with other papers which I have to read. Now, I also, as a sort of form of truth in advertising, should tell you that I was at one point in my career both the CEO and CFO of a US broker-dealer. And indeed, one of the things I did while occupying that role was to buy a small savings and loan in the suburbs of Detroit. Um, Now, immediately in listening to your description of what was going on here, I have to ask you the obvious question: how did this start? Was it we are going to buy mortgage-backed securities, subprime mortgages, and so on, in order to make money and have a profitable bank, or was it conceived as a fraud from day one? Was it an attempt to make profits for the bank using those securities, which failed and turned into a fraud, or was it preconceived as a fraud? That, I think, is the most important question to answer with this. Um, the other thing I would caution a little is seeing this as predictor for the 2007-8 financial crisis. Um, That crisis, the subprime crisis, was indeed a failure of subprime mortgages, but you have to remember that the subprime mortgages that existed at the time, there were about $1.3 trillion worth. And what really did the damage was the derivatives on those subprime mortgages, which actually amounted to about 4.7 trillion.
Mm.
So they were almost 3 times the size of the underlying mortgages. And of course, then that's effectively leverage on those. And the moment rates started to rise, we saw cash flow problems and everything else. But the question for you is, how did this come about initially?
Thank you, Carl.
Well,
Great
to
question.
answer that question, how it came about initially, Knox McConnell went to a seminar on the West Coast, and the person, Dan Melgar, was touting the benefits of investing in subprime mortgages. And so Knox McConnell was intrigued by it and gave the assignment to Terry Church to go out and talk to Dan Melgar and see if they could start investing in subprime mortgages. Knox McConnell had no idea what he was doing, but that didn't deter him. And yes, he wanted to make a profit. He wanted to really be number one, even though he was CEO of a tiny little bank in the middle of nowhere. He wanted to be number one. One of his fans was a boxer by the name of Billy Conn, who almost defeated Joe Louis in a heavyweight bout just before the outbreak of World War II. And so he emulated Billy Conn, who was almost number one. Knox McConnell wanted to be number one. He wanted to make a profit. And I don't think he was mindful of it being a fraud from the beginning. It was only when they got too far into it and realized that they were losing money that he needed to falsify the books and records and pretend that he was the most profitable bank in the country. The American banker had his picture prominently displayed when they announced that his bank was number one in the entire country. And he was so pleased with himself.
Wow. Fantastic. Fantastic.
Like Trump and his covers.
There's research out there, isn't there, that there's a particular type of personality that some bankers have that makes them a bit like sociopaths. It's remarkable, absolutely remarkable. Thank you, Con. Thank you very much again, Bob. Let's go to Michael Loughnane, then we'll go to any other final points. Then we'll start bringing our conversation to a close. It's been fascinating. Michael, you're next. Thank you.
Yes, hi everyone. I'm sorry if I need to oh, I should check this. Can you hear me okay?
We can, Michael. Yeah, we can.
Okay, wonderful. Thank you. Bob, it has been quite a few years, my friend. How are you?
Doing
I
fine.
still have when you issued out your book at the ACAMS meeting, I had the signed copy that
Oh,
you
very
gave
good.
me
Very good. Thank you.
back in the day. And then a regulator borrowed it from me, and I haven't seen it since. So may have to get another copy, but it's a fascinating story. And if you folks haven't read it, I would recommend it to the highest level. No real questions, Bob, other than I just wanted to let you know that in all the years since I have been teaching and training law enforcement from your book, I still reference it. I still reference the story of the FBI moving around in the field looking for those buried records.
Right.
And one of the points that Bob, and correct me if I'm wrong, because we both know Dennis, who was leading the team at the time, who was at the meeting. We've known
Yes.
Dennis for quite a while. When they couldn't find the records, it turns out the gentleman who was with the backhoe at the field happened to be the same guy who buried it. Kind of
Wow.
made it a little,
I didn't know.
kind of made it a little easier to put it together. So anyway, it just was fascinating. I think I picked it up from another newscast on the story. But I will say the timing that this came out, and one of the things Bob has been one of the founding leaders in, and I just want to praise him for that, is back in those days, the knowledge and skill set of law enforcement in this work was really far and distant apart. Bob's work in growing it and working together and helping develop better investigative skills to make a better understanding of this complex area. Folks, I can't speak for over the pond, but the guy you're seeing on the screen here was one of the fundamental points, developments in the United States, helping grow that whole challenge. So, as I said in my chat, Bob, you are my hero. I told you back then, I'll tell you that now, and I'm glad to see you well. Thank you, my
Well,
friend.
thank you so much. You're too kind. Thank you, Michael.
It's lovely to hear such authentic and sincere comments from one professional to another. Thank you so much, Michael. And Bob, this is a great conversation. We're going to go to Mr. Nigel Keynes. For those of you who don't know Nigel, Nigel's an A1 TGF volunteer, supports a great deal of our work with all kinds of insights. Nigel, please share your thought. Thank you.
Hi, Bob. Yeah, what an astounding presentation.
Well, thank you.
Absolutely mind-blowing. But one wonders just how many documents that were forged during this process that were treated as authentic by the bank examiners. It seems almost implausible that so many documents could have been successfully passed off. They must have been absolutely master forgers, or, what's the explanation behind it?
I think that is the answer. I think they were master forgers. And the examiners, with regard to the loan servicer reports in particular, the examiners thought that they were untouchable, that they couldn't be forged, they couldn't be altered. And it finally dawned on them that that was the case. They didn't know that the bank had the ability to alter them and give them forged, dummied up documents. So, they were operating under a misapprehension, unfortunately, and the other documents were just extremely well done.
Well, perhaps it's easier to forge documents than we actually realize, and it may have gone on elsewhere as well.
Right.
Yeah. Wow. Folks, I'm going to share my screen and elaborate on something I put in the chat earlier. So let me just get the right thing up. Here we go. One of the concerns we have in the UK is the danger of deregulation. And of course, deregulation really does carry a great deal of risk, hence our concern about it. And I'm just going to make you all aware of a resource that some of you may be familiar with, some of you may not. And it's called the Trump Deregulation Tracker. Now, I should make a point here. Transparency Task Force has no position on political matters. So this is not about Donald Trump per se, but it is a fact that the current administration in the US and the current government in the UK have an interest in deregulation. We haven't got time to go into the detail here, but what I can do is simply tell you that this database exists. I like it a lot. You can search it by agency. So, for example, I'm really interested in the CFPB, the Consumer Financial Protection Bureau. So if you click on CFPB, you'll get all the deregulatory activity impacting the Consumer Financial Protection Bureau. And one of the reasons for mentioning this is because some of you will know the Consumer Financial Protection Bureau was created as a consequence of the financial crash that's been referred to. I think it was Senator Elizabeth Warren who spearheaded it. And isn't it remarkable that the very regulatory response to the global financial crisis is being chipped away against? I'm going to go to Bob now for his final comments. Bob, feel free to comment on your thoughts about the dangers of deregulation and any other final comments you make, and then I'll close today's meeting. Thank you, Bob.
Well, thank you very much, Andy, and thank you, all the participants. I really appreciate your comments and your support. In terms of regulatory issues, I think that the deregulation issue that Andy just referred to is an extreme one, and one that concerns me greatly. I spent 30 years at the OCC taking enforcement actions against banks and bankers who were not towing the line, trying to protect the underlying depositors and shareholders. And this is being put in the back seat. The regulatory agencies have been reduced in size and in power. And, it's just a different world out there now. And it's not one that protects the depositors the way it should. So I'm very concerned about, our ability to withstand this effort to deregulate across the banking industry. I think it's unfortunate, and I think it's something that needs to be reversed.
Thank you very much indeed. And if I may ask you one final question, Bob, I'm so interested in this. What was the thing that very first led you to think, you know what, I'm so astonished about this, I'm actually going to write a book about it? What was it that kind of took you from being actively interested in the subject to thinking, you know what, I'm actually going to commit all my time, all my effort in producing a book about it? Thanks, Bob.
Well, it's an interesting question. The bank failed in 1999, and of course, it was very much a big story for us at the OCC at the time. And I was 6 years away from retirement, but my wife suggested that I retire early and write a book about it. And she was half joking. But years later, I thought about this case and looked up on a map and found where Keystone existed. I couldn't even remember the name of the town. So I started researching the book and obtaining the court records, the transcripts, and then one thing led to another. And it took me over the course of 4 years to pull it all together and to write it.
Thank you very much indeed. If I find it in time, I'll add a link in the chat to a great speech in July last year by Senator Barr. No, forgive me, Governor Barr of the Fed, talking about the risks of deregulation and the cycle of deregulation leading to crashes, crashes leading to regulation, lobbyists fighting back over time and chipping away at the regulation, and you have this ongoing cycle. I'll try to quickly find it before we wrap the session up. But what I'm going to do now is close with one particular thought. All of these incidences of financial crime, scams, scandal, catastrophic regulatory failure, sometimes willful blindness by regulatory authorities, even auditors, etc. None of this stuff is victimless. None of it happens without causing real harm and real detriment. Sometimes it's quite small and trivial. You might lose a few pounds here and there on hidden fees in investments and pensions over a long period of time. Of course, it will aggregate to a great deal. At the other extreme, people have literally taken their own lives because they've lost their entire life savings because of catastrophic regulatory failures. There's an example of what I've just spoken about in the early day motion that was put in the House of Commons a little while ago. Somebody we knew who took his own life, one of our volunteers. I've just put a link to that particular matter in the chat. So the point I'm making in a very roundabout, rambling way is it is phenomenally important that we as citizens, hopefully good citizens, speak up when we see things that are wrong. And that's a point I really genuinely believe in. That's why when the conversation with Con Keating back in 2015, sorry, late 2014, that led to the creation of Transparency Task Force, a conversation I'll never forget, Con, you and your cigars, um, makes me a very proud man doing what I now do, helping to run a campaign group that's all about getting people to speak up and speak out and work together to make the world a better place. So with all that in mind, I'm going to refer to a quote that I often find myself wanting to refer to, especially when we have folks from the other side of the Atlantic with us. So we'll close the event on this point. Robert F. Kennedy, back in the 60s, of course, a time when it does seem the world was a little bit more progressive than it is today, I would say. Robert F. Kennedy, every time we turn our heads the other way, when we see the law flouted, when we tolerate what we know to be wrong, when we close our eyes and ears to the corrupt because we are too scared, too busy, or too frightened, when we fail to speak up and speak out, we strike a blow against freedom and decency and justice. Well, there's a lifetime's wisdom in that, isn't there, folks? Can we once again show our appreciation to Bob Paisley and his wonderful book, Anatomy of a Banking Scandal? Well done, Bob. Thank you very much indeed. Thank you very, very much indeed. I wish you all a lovely rest of your evening in the UK, afternoon in the States and elsewhere. Thank you those who've joined from France, from Canada, from the USA, from the UK, and wherever else you may be. Bob, it's been a pleasure working with you on this. Thank you very much indeed. Cheerio all. Bye-bye. 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 Thank you.